All right, let's dive in. Today, we're going to unpack a crucial piece of the global economic puzzle, commodities. And look, if you're an MBA student or a future business leader, getting your head around this asset class isn't just optional, it's absolutely essential. So, let's get to it.
So let's just get right to the heart of it. The big question you're going to get in a strategy meeting or a final round interview. Why should you, as a future portfolio manager or strategist, actually care about the price of oil, gold, or even coffee? I mean, how do these raw materials really fit into a modern investment strategy? That's exactly what we're going to break down.
So here's our game plan. We'll start with Commodities 101, just the basics. Then we'll get into the big global price drivers. After that, we'll talk about investing, the tools you can use, and the traps to watch out for. Then we'll define the role they play in a modern portfolio. And finally, we'll wrap it all up in your MBA toolkit.
Okay, let's kick things off with Section 1, Commodities 101. Before we can even think about building a strategy, we've got to understand the fundamental landscape of what we're actually working with.
Okay, so the first thing you have got to get straight is the difference between hard and soft commodities. Hard commodities are the things you pull out of the ground. Oil, gold, copper. Their prices get pushed around by huge macroeconomic trends and industrial demand. Soft commodities, on the other hand, are grown or raised. Think coffee, wheat, pork. For these, the biggest risks are things totally out of your control. The weather, a sudden disease, or even a change in biofuel policy. Two totally different risk profiles.
But here's where it gets really interesting, because those lines are starting to blur. Take silver, for example. We all tend to think of it like a mini gold, right? A monetary asset. But look at this. A full 60% of silver demand today comes from industrial uses. We're talking electronics, solar panels, electric vehicles. It's becoming less of a precious metal and way more of a critical industrial component, and that totally flips the script on how you should think about its price.
Okay, so let's move on to Section 2 and see how this all connects. The global price drivers. You see, commodity prices don't move in a vacuum. They're being pulled and pushed by some of the biggest puppet masters in the entire global economy. And you can really boil these forces down to three key systemic drivers: the value of the US dollar, US interest rate policy, and of course, those sudden geopolitical or supply shocks. Let's start with the one that's often overlooked but has a massive, massive impact.
And this quote just nails it. Think about it this way. Almost all major commodities around the world are priced in US dollars. This creates this really simple but powerful inverse relationship. When the dollar gets weaker, it just takes more of those weaker dollars to buy a barrel of oil or an ounce of gold. So their prices go up. A weak dollar generally means strong commodities, and vice versa. It's a fundamental link that way too many people forget. So that's the why. Now for the how. Section 3, Investing, Tools, and Traps. How do you actually get exposure to these assets, and what's the one huge hidden trap that gets almost everybody? Okay, pause. Before we go any further, we have to nail down this one term, roll yield. See, most commodity investing happens through futures contracts, and those contracts have expiration dates. Rolling is simply the process of selling your expiring contract and buying the next one out. The profit or loss you make just from doing that is the roll yield. The key takeaway here is your return doesn't just come from the commodity's price changing. A huge chunk of it can come from this roll yield.
This roll yield can create two very different situations. The one you'll see most often is called contango. The easiest way to think about this is like you're paying a monthly storage fee. The future price is higher than the current spot price, so when you roll your contract, you're basically selling low and buying high. That creates a negative roll yield. It's a constant drag on your returns. Now, the rarer, much better situation is called backwardation. This happens when everyone wants the commodity right now. The spot price is higher than the future price, so you get to sell high and buy low, generating a positive roll yield. It's like someone's paying you a premium just for having the stuff on hand.
And look, this isn't some abstract academic idea. This quote shows the real-world damage. Because of that contango drag, it's totally possible for an oil ETF to lose money over a year, even if the actual price of oil went up. That negative roll yield can literally eat up all your profits. It's a huge trap. So this leads you to a really critical choice when you're picking how to invest. With a standard futures-based ETF, your biggest risk is that contango drag we just talked about. The alternative is an exchange-traded note, or ETN. It gets around the roll yield problem, but, and this is a big but, it introduces a completely different risk, issuer credit risk. An ETN is basically just a loan to a bank. If that bank goes under, you could lose everything. So the trade-off is crystal clear. Do you want to risk performance drag, or do you want to risk the bank failing? Oh, and ETNs also have a nice little tax advantage. All right, so after all that, let's pull it all together in section 4. This is the so what? I mean, after all this complexity, why should a portfolio manager even bother with commodities in the first place? This number pretty much says it all. In 2021, when inflation came roaring back out of nowhere, the main commodity index shot up over 40%. At a time when stocks and bonds were really struggling, commodities offered some serious protection. And that, right there, is their main role in a modern portfolio.
In this table, it lays it out perfectly. Look, during a recession, commodities stink, so do stocks. In that scenario, long-term bonds are your hedge. But what happens in a high inflation world? Well, now stocks and bonds are giving you below-average returns, but commodities are an excellent hedge. So here's the key idea. Commodities are not a constant diversifier. They are a conditional hedge. They work best precisely when your traditional 60-40 stock and bond portfolio is at its most vulnerable.
All right, let's bring it home with our final section, your MBA toolkit. We're going to boil all of this down into some really actionable takeaways you can use in your career and, yes, in interviews starting tomorrow.
First up, here's a number you should probably jot down. For a standard balanced portfolio, big institutions usually target a 4 to 5% allocation to real assets, and that includes commodities. Now, here's the fascinating part. As of early 2024, the actual allocation was just 1.7%. That's a huge gap, right? It tells you institutions are way underweight, which might just spell opportunity.
So if you walk away with nothing else, please remember these 3 things. Number 1, commodities are a conditional hedge, specifically against inflation. Number 2, you have to watch the futures curve. That roll yield from contango and backwardation is a massive and often hidden driver of your returns. And number 3, know your instrument. The choice between an ETF and an ETN is a direct trade-off between performance drag and credit risk.
And to make sure you're ready to walk into any interview, here are 3 tough questions that, honestly, you can now crush. How do commodities fit in a 60-40 portfolio? You know the answer, as an inflation hedge. Can you explain roll yield and contango? You've got the storage fee analogy in your back pocket. What macro factors would you watch for copper? You talk about the US dollar, interest rates, and key industrial indicators like the PMI reports. This briefing has given you the framework to not just answer those questions, but to really impress. The only question now is, how are you going to use it?